Welcome to the Money Metaphors podcast with your host, Jason Coddington. Jason, good to be back with you. How are you, my friend?
Yeah, good, good. It's good to be
Yeah,
back.
you've got a topic on the table today that I don't hear discussed actually too often. I get a mailer in the email. I get a mailer in the mail about them all the time. But life insurance seems to be one of those things that just doesn't get really a good discussion, or at least not that I'm aware of.
Yeah, I think, it's absolutely part of financial, it should be part of a financial plan.
Hmm.
So we should discuss it. And I think there's some confusion around, there's a lot of confusion around insurance and what type and how much you
Yeah.
should buy. And, so today we'll kind of give you some benchmarks that I think you can use that are important. The story I'll just tell real quick is, the first life insurance death claim I ever processed was my own father's. The interesting thing there is, he just bought a policy to kind of, I'll just help you out. You're getting started, and then little did we know that he was going to have, cancer. We ended up losing him 16 years ago, but my mom is still in the house today, largely because of that insurance policy. So
Wow.
it's a pivotal, it's a pivotal, it was pivotal for for my mom,
Mhm.
and for our family, and so it's impactful. And it wasn't, and in my dad's case, unfortunately, it was a small policy. Probably should have been more, but it was enough to keep mom where she is. So I think it's
Yeah.
important. And but today, hopefully, your takeaways are that when you try to figure out how to get how much insurance to purchase, you're going to have a good idea after this, listening to this podcast, and then you can be educated on the types of insurance and go from there. But the bottom line is, most importantly, is that your family is covered. And of course, the insurance isn't for you. Ben Franklin once said, there's only two things that are certain, and that's death and taxes. And I agree with that. If I could bring him back, I would ask him to change that quote and add two more things. And the other two things to death and taxes that are certain is inflation, of course, and uncertainty. So
Yeah.
uncertainty is certain. So um, insurance helps with that. Planning helps with that. So we'll get into that today. And so yeah, well,
Great. Well, then, why don't we start with the basics? How do you know how much life insurance to buy for crying out
yeah, I think the way to consider that, the one way to look at that is how much, if you just met someone on the street today and just said, how much would someone have to write you a check for so that you didn't have to work anymore in the rest of your life?
loud?
Think of it that way. Now, we'll get into that a little bit of a nuance, and we'll use some examples. But um, think of that. If you're without inflation, we'll just do it. Normally, if you as a family, you're making $100,000 a year and you work 30 years, you got a chunk of change running through your hands,
Yeah.
there. So, um, you know, in that case, 3 million bucks. I mean, that's a lot of money, right? I mean, so how much of that, so if someone today on the street said, how much would you have to say? And well, the quick math, not counting for time value of money, would be, well, you got to give me 3 million bucks for me not to work anymore, right? so
Yeah.
so we'll get into that. I mean, that's a quick way. But I think the reason I use that example is, how much would I have to write you a check for you to stop working, is it changes the perspective, right? Because now it's about you. Like, it's about you as an individual, how much money is going to pass through your hands. And like, so it starts to think, man, I'm going to earn, if I'm truly earning something, uh, how much what is my family going to have to do if I'm gone? And so there's a couple
Yeah.
ways. And so when you start looking at first, so we'll just kind of dive into how much should you buy. There's really two ways. One's needs based, and that's kind of expense focused.
Okay.
And then there's some calculations. There's income based, which is, we use a calculation of the human life value. We don't believe you can put a value on a human life. However, that is a calculation, and we'll talk about that, lifetime earnings. It's similar to the one about the example I just used with the wallet, but we'll start with the needs-based, right? So needs-based basically says, um, it looks at it from, okay, if you're gone, how much money will your family receive from different benefits? So, if you're a teacher, depending on your age, if you're a teacher, if you have young children, Social Security for the children up to a certain age, there's these different rules. And I think where we run into issues here is that people want to just, they want to trim their expenses. Well, if I'm gone, they won't need this or they won't need that. So the needs-based approach is basically say, okay, take your net paycheck, subtract what you save per month,
Okay.
401k and whatever, and that's left, that's what you spend. And then you multiply that, that's per month. And then you figure out, okay, how many years until I retire? So if that's going to be, um, let's say if you're 30 and you're going to retire at 60, you would want to provide that kind of expense per year for 30 years. That's needs based. And we'll have some resources in the, in the show notes here that you'll be able to use and calculate your own. But so the way it look like is, okay, well, if I'm working and I bring my net paycheck comes in after paying taxes, I have, let's say $5,000 a month that I have left after saving to spend and live on. So I do $5,000 a month times, uh, times, 12, that's $60,000 a year, 30 years, of course. And again, I'm not using the discount method here where we'll actually
Yeah.
use it. And so that's going to be 30 years at 60,000, 1.8 million. That being said, that would be a minimum start. If you want to pull that number down, then you start using time value of money assumptions where it's like, okay, you discount the dollars back into today's value, and you could probably get to somewhere about $1 million. But then from there, that's needs based. So that's the first calculation. And then the second piece to the needs based is, what goals do you have? Okay. So, and I think this is a theoretical question, I think, that we like to ask clients when they start thinking about how much to buy insurance. And the framework we like to have them think through here is, when you're gone, are your financial goals still going to exist? So for example, let's say we have, a husband and wife and they have 3 children, and they're all, let's say they're all under the age of 10 and they want to have college education paid for. Well, if that's
Right.
their financial plan and that's their goal while they're both alive, the question I would ask, do you still want to have that goal achieved if something was to happen to one of you? And if the answer is yes, then you have to add that to the needs base. So if a college education, right now it's pretty, if they're younger, you can say, okay, a California state school, we live in California, is probably, room and board currently $25,000 to $30,000 a year. And then again, that's all in. So, and that's maybe on the higher side, depending where you live. If you're going to school in San Diego, it's going to be higher than that. If you're going to school in, Chico, it's going to be lower than that. The point is $25,000 a year, a 4-year education, that's $100,000 per child. So if you have 3 children, you would need 300,000 just for college education if you died tomorrow. So,
Yeah.
so you would add that to that 1.8 million. And then any other goals that you have, and we just go through that. And that's kind of the needs/goals based approach.
Okay.
And what we find is when we go through this with people is the number is astonishing. Some people think, and I almost forgot a big part. Debt is the other.
I was
So
going to ask about that. What about like
yeah,
my
no, yeah,
mortgage or
sorry.
something like that?
So let me back up a little there. So you also want to add up, if when you're retired, you plan to have your debt paid off, you can also help your family out by paying off your debt now. And so what debt do you have? Is it an auto loan? Is it student loan? Is it the biggest is a mortgage? You would add that to that number as well. Now, depending on your age, where we see people slide on this number and says, well, we'll take a husband and wife, and then we ask the husband, hey, what do you think about all this? It's quite a bit of insurance. We're up to 2 million and something, and be like, man, that's just a lot. The premium's going to be big. And so everybody goes to the premium.
Yeah.
We like to say, well, let's not talk about the premium. Let's just talk about what we want to cover. Does it seem like it's too much? And um, the answer might be, if the answer is yes, then the question becomes, okay, well then the only way to make that number smaller is to either sacrifice the goals or reduce the amount of years for which there'll be coverage, right? So instead of 30 years, okay, well, I'm 30, I can get my family through until, and husband and wife assume they're the same age. If they're both 30, my wife would then be 50. Kids would be out of school, debt's paid off, is that becomes the conversation, right? Like how many
Yeah.
years? So the conversation becomes not about the premium, which it should, I mean, of course it gets there, but I would rather someone listening to this today think about what is the total, what do I need to cover? And then we can work through the different choices, but we're advocates that say, your family shouldn't take a pay cut just because you're gone. So,
Yeah.
and that kind of leads me to the next
Well,
approach.
it's also like worth interjecting here while we're talking about that. Life insurance when you're 30 is a lot less expensive than life insurance when you're 50.
Yeah. Yeah, exactly. That's a whole nother, your age is
I mean, I'm not trying to jump
matters.
ahead of the
No,
conversation,
no,
but
no, that's good. Yeah, no, well, and another piece to that, and we'll use my dad as an example. I mentioned him at the beginning of the show.
right.
There's this, we like to talk about insuring your insurability. So, if you apply at a young age, and heaven forbid something happens to you, we have a young individual in our community right now. He's 40 years old. Um, he's losing a battle to pancreatic
Mm,
cancer. 3 kids under 18. It's tough, and but had that individual, if that individual has insurance, if they would have bought it, earlier, or if he was to, quote unquote, turn the corner, he won't, in this case, he's not, and then so it's very unfortunate. But um, the should he recover, or should an individual have cancer and recover, if they have an old policy, they're okay because they have the in
yeah.
place. If they were to go get a new one, they wouldn't have it. They wouldn't be able to do that.
Right.
They would have to wait some period of time. Some cancers are different than others. Skin cancers easier to, certain skin cancers are easier to get. I mean, this is all underwriting type things, and I don't want to get too
Oh, I
far down
know.
that. But the point is that, that's insure your insurability, buy it young, and then should have something happen to you, unfortunately, and heaven forbid something happened to you early, at least you have the coverage, right, for your family. But
Yeah.
if something happens and you were able to recover, you at least have the insurability, and
Yeah.
that's what happened with my dad's case. And this is we'll talk about that a little bit later, but uh he insured his insurability because had he applied 5 years later, he wouldn't have been able to get insurance. So,
Yeah.
so
That's crazy. Yeah.
yeah. So hope that helps with the needs-based approach. So needs-based is expense-based and goals. Then we just jump to this other one that, I hate the phrase, the human life value, but it's the approach to come to it. And the way to look at this is, think of a wrongful death lawsuit, right? So,
Yeah.
you walk out of your office or your front door, and there's far more UPS vehicles on the road. Amazon has a fleet, FedEx has it, with everybody buying stuff online. Let's say you walk out your front door, you cross the street, and you get hit by, a parcel vehicle, right? So now the family's, you know, meets with an attorney, and they're trying to figure out, okay, we have to do a wrongful death suit. So, well, of course, in a lawsuit, the number is going to be the number is going to be huge because there's punitive damages in there and everything. But they have to
Right.
calculate. Okay, part of their process will be calculating what was the lifetime earnings of this individual, and so they'll do that, and of course, then they'll add on for uh, court costs, attorney fees, and those kinds of things. But it's born out of that formula. And
But it's
so
kind of it is a real calculation that is also kind of cold.
it's very
Yeah.
cool. Yeah. But I think, and there's two ways to do it. One's going to come up with a big number. The other way, of course, we've talked about the discounting. And that when you discount a future number into like a present value,
Yeah.
it's kind of like the lottery winners. If someone wins a lottery, if you win $7 million in the lottery, and you take it over, it's a $7 million, but you got to take it over 20 years, or you can take a lump sum and that 7 million is now 4 million. So same thing, right? So
Yep.
it's the human life value is that in reverse. So how many earning, what do you earn now? How long do you plan to earn it? And then, again, so take the 30-year-old is going to work 30 years, $100,000 a year. That's 3 million. That's going to pass through your hands. If you want to add, so you could just stop there and the family would have your earnings and they would have the ability to pay off the debt. They would have the ability to fund the goals that you're already planning for. So, or if you want to just, candy coat that or sugar coat that, it'd be 3 million. And then you would add, on top of that, you would add all the goals, right? So
Yeah.
college education. And then of course, you would add, the debt, and then you would have that. Now that becomes a big number, right? So if it's 2 million in the last example, now we're talking about 3.5 million. And now you start thinking about premium. Well, that's when we go through and we do a human life value calculation, and so that 3 million, number would be, less than that, and so that's where we go through and calculate that for you. And we'll have some tools in the show notes that'll show you exactly what that would be for you. But, and again, if you want to shorten that or reduce the amount, you're really talking about timelines and goals, but, either way, one's income based, I will tell you that, and I'm sure there's some studies on this, most people underbuy, right? I mean, most people underbuy
Yeah.
insurance
Probably do. Yeah.
because they're buying on premium. So let's talk about now, okay, whatever way you chose. So if in your mind, if you're listening to this and you're saying, okay, I know what I make and I've done kind of a rough sketch of how in the world how do I cover this? How do I cover my insurance need? And so we're going to now switch gears and go to the uh, types of, types of insurance that you can use. And we're just going to do a, kind of a flyover 40,000-foot view of this. And then, of course, if there's additional questions, we're always available to answer, more detailed questions for you. But you should at least know what tools are available once you determine how much you want to cover. So,
Good deal.
uh, so yeah,
So how does it work?
well, yeah, so there's three moving parts, primary parts to insurance. So there's the premium, which is what you
Mhm.
pay, of course. There is the death benefit, and that's the amount that your family will receive when you're gone. And then there may or may not be, depending on the type of insurance that you buy, have cash value. And so we'll talk a little bit about that. So real three keys there. The important thing to understand about life insurance is under current law, it is income tax free to your family. So, that's another way if you're looking to reduce the total amount, if you using that last example,
Yeah.
3.5 million, multiply that time, if you're an effective 20% tax rate, you could multiply that number times 0.8, factoring for that reduction in taxes, and you can bring that total number down, as an example. And of course, and it's not like that money, when you're gone and the family receives the money, it's not like it's just going to sit in one place. That money would then be invested and allocated to earn over the next 30 years. So, that's something to remember as well. So back to, again, three components of life insurance. Any life insurance policy is a death benefit, premium, and cash value. And so, or is there cash value? And so we'll now jump to the two types of insurance. So three components: premium, death benefit, cash value. Now we'll jump to the two types, and you're going to hear phrases out there. You're going to hear whole life, universal life, variable universal life. term insurance, and we're just going to break it down. There's only two types of insurance. Okay. One is term and the other is permanent. And so what in the world's the difference? So we'll talk, there's different phrases or examples that people like to use. I like to keep it really simple. Term insurance basically is you're buying a specific amount of insurance for a specific amount of time.
Gotcha.
And, and typically those time frames are 10-year, 20-year, and 30-year. As you get older in life, you get to that 50-year mark, people are living longer. The 30-year policies tend to fade or go away. So, so the younger you are, the longer term. There are some 40s out there, I believe, for younger individuals, but term insurance. But term insurance, quite simply, so we'll use our example. Let's say we'll just use 2 million from this for the rest of the
Okay.
conversation today. $2 million life insurance policy. We're going to go out and we're going to buy, $2 million life insurance policy, and it's going to be for 20 years term. Okay. And if you're 50 years old, we'll just use that as an example. The premium on just a standard, not preferred, or not a super healthy, but just a standard individual, that premium would be, and we've got several quotes here, but it'd be around $5,000 a year. Okay.
Okay.
Or $416, dollars a month. So
Gotcha.
that's term insurance, and it's not an exact science, but if you were to cut the term in half, 10 years, it would be almost half that, slightly more because you get a benefit for a longer time frame. But, so then you're looking at $2,500 for a 10-year time frame. So I hope that makes sense. So the component there with a term insurance, you have a premium in this case, for 20 years for a 50-year-old, getting him to age 70, $5,000 a year, or, $416 a month. And then to break that down ridiculously, if you divide, $416, by 30 days a month, for $10, $10 a day, you're covering your family, in the event that you're gone. So, and people spend $10 pretty easily. I mean, it might be, maybe it's 15, let's call it 50. I guess that'd be a better example. So $15 a day, you can cover your family for the rest of their life. I think, minimum wage in California is, $20 an hour for them. Well, for the most part, it's very close to $20 an hour. So, for the first, think of it this way, the first, first day of the month when you work, 3/4 of the first hour of the day of the month you work is to protect and ensure your family has income for the rest of their life. And
Makes
it's kind of,
sense.
it's the leverage is important. So term insurance, specific time frame, you pay the premium. Now here's one thing I mentioned, that phrase cash value. There is no cash value in term insurance. There's nothing build up. None of your premium sits there. It's, you pay it and it's gone. Just like your auto insurance, your health insurance, you pay it, you don't get anything for. The one thing about life insurance, it's the only insurance that you'll pay for that you're going to claim on. Someone's going to claim on it. So what I'm saying is that we're all going to die. So
Yeah, we are.
yeah. So when I say that, it's, you may or may not have insurance when you die, but you are going to die. So you are insuring a certainty where, now with my driving record, it's a high probability I might get an accident. So, but auto insurance is different than that. Fire insurance, of course, is different than that. It's a possibility, but it's not certain. Life insurance is certain. So,
So what's the difference? What's the difference between term insurance and whole life? You mentioned whole life. What's that?
So
What's the difference?
let's walk through permanent insurance. So permanent insurance means you have it forever. You can have it until you're dead. So, think of it that way. So permanent, as long as you pay the premium. So the componentry is the same. But for example, there's many different types of permanent insurance. So under permanent insurance, the first type, most common, is whole life insurance.
Yeah.
Then the next is universal life insurance. And then the last is, variable universal life insurance. Then, of course, there's something else that I'm not going to talk about today. We'll save that for an estate planning conversation. And there's what's called second to die insurance, and that's where you can insure two people, and that's really used more in the estate planning realm. But we'll
Sure.
table that for now. So whole life, quite frankly, with whole life, you're investing you're going to take your premium, and so in the case of the term insurance, just let's imagine that premium for term insurance, as we talked about, is $5,000. Well, in the whole life policy, the annual premium could hypothetically be $8,000 a year. So what's happening there is, and this is again very elementary, is you're paying 8. So what's happening? 3,000 goes towards the cash value, and the 5,000 would go then to the cost of insurance for that policy. And then you keep doing that. And what happens is over time in that policy, you start to build cash value. Why that's important is because now the cash value is growing. And as your cash value grows, you're getting older, insurance is costing more. You then get to use that cash value against your death benefit to reduce the cost. Or if you're
Okay.
or if you would like, you can take and buy additional insurance with the cash value that's in there.
Gotcha.
And the difference between really whole life, universal life, and a whole life, universal life, and variable universal life really is how you earn income. So for example, on the cash value, on whole life, for example, the cash value is you're going to earn a dividend, if you will, from the insurance company, predicated on the performance of the insurance company. They'll return you a dividend. Okay. And that's typically historically anywhere from, 3 to 7%, depending on the company. Then you
3
jump
to
to
7% of the value of the policy, or
the cash value. So in
okay.
that first example, if you had $3,000 in there, you would likely, potentially see a 7%, income on that cash value.
Oh,
So,
okay.
at the high end, and, or 5%, if you will, on that. And so you earn that. And then again, with those dividends, you can buy additional insurance, or you can just have it go against your cash. The big thing with whole life insurance, or permanent, and universal, and or permanent, the big thing about permanent insurance, which includes whole life, universal, and variable, is you're theoretically, you are actually building equity for your future. And most of these companies, universal life, variable universal life, and whole life, as long as you pay the minimum premium, they have this feature called a minimum death benefit guarantee. So irrespective of the dividend that you receive, or the performance of the universal life or the variable universal life, as long as you pay that minimum premium, no matter what happens to the value of that policy, if you've paid that on average throughout the life of the policy till your death, and that you could be age 97. There is no term on this. Okay. There is no term.
Yeah.
They're going to pay that death benefit to your family.
Oh,
So that's a feature. Over time, if you start early, I think one of the things, so I'm going to transition slightly and just talk a little bit about universal life. Universal life is really very close to whole life. The nice thing, universal life, what you can do is things are more, a little bit, typically the phrase they use with universal life is flexible. So what you can do is you can reduce the death benefit. You can, if later in life you don't think you need, $2 million, you can reduce it to $1 million. You can, you can't raise it without evidence of insurability, with most insurers, but you can reduce it. And so that's kind of nice. You can add riders, that are, like a term, it's called an insurance rider, with that you want to just cover something certain for like 10 years, let's say, and then that rider will fall off. So universal life has those features. And the only difference between universal life, and then universal life is typically invested in fixed investments. So you're going to get quote unquote bond like returns, if you will, fixed income returns. And then, the last is variable universal life, which is, the cousin of universal life. And the only difference between that is the cash value is invested in equity type investments. So basically, mutual fund sub accounts. So you can get higher returns. One thing I will say about all of this, around all of these examples with permanent insurance, um, is it's absolutely paramount that when you buy this policy, you review it at least, every 2 years. We say annually, but every 2 years. So it's very important to do that. And here's why: is many people bought universal life policies back in the late 80s, and you remember what the interest rates were, right? They were in,
Yeah,
inflation there, 12, 13,
they were
14.
high.
Right. So a lot of those policies started out in that 14% range. And so when people bought those policies, they assumed that they were going to get 13% or 12, 13% for the rest of the policy. So what happens, it impacted what premium people were paying. So what happens, we obviously didn't get 13% for the next 25 years. So what
Yeah.
happens, and people were ending up paying on these policies for 10, 15, 20 years, and then getting a notice from the insurance company and said, hey, you need to increase your premium because there's not enough cash value in here to keep it alive. And so it's very important to renew it. And you're like, well, why is that? Now, if you have the minimum death benefit guarantee, it's not a problem. But if you're underpaying the premium, or if you skip a couple here and there, you're going to get that notice. And so we really like conservative estimates here. In my opinion, this is available with whole life, universal life, and variable universal. You can increase your premium. You can add funds to your cash value, if you want, because life insurance is a vehicle that can grow tax deferred, like other items, in our quiver for financial planning.
Yeah.
However, I would say, again, every situation is different. Fully fund as much as you possibly can with term insurance. So we like doing combo plates, right? So my favorite, 2 cheese enchiladas, rice and beans. So do a big term policy and a small permanent policy. And the reason for that is you have the ability you want to fully fund and make sure that your permanent policy is going to have enough cash in it in the future so that it doesn't, quote unquote, run out of money.
Yeah.
And make sure you're covered. And the other reason I would say, and again, this is very important, is a feature that we used again with my father, is this, and this is what's nice about term insurance. Most term insurance policies, when you buy your term insurance policy, you can it's either built in or you can add it as a rider, but you have the ability to do what's called a term conversion or conversion to permanent. Okay.
Oh.
And so what's nice about that is, okay, so now what's nice about that is you can insure your insurability because they're not going to go back and go through underwriting. All you
Yeah.
have to do is pay the increased premium now at your new age when the policy matures. So if
Gotcha.
you buy a 10-year term and you're 10, it's up. Hey, would you like to convert this to a permanent? Hey, you know what? I was sick. I would, and I'm not going to qualify for insurance. Yeah, I'll pay the new premium. It might be expensive, but it's not gonna count. So it's not gonna hurt. Because if I was to apply on my own, I wouldn't pass underwriting. So you at least have coverage. And so in my dad's case, he had a term insurance policy. It came up on his 10 years. It was diagnosed and they had given him 4 years to live. He had prostate cancer that had metastasized into his bone. And when his term insurance policy, he was in year 2 of that 4-year window. And so we needed some coverage. And so what happened is he converted his term insurance to a permanent policy and used funds from his IRA to fund the additional premium for that. And that is how my mom was able to stay in the house that we grew up in. And so it's a very important feature. But kind of to recap there, there's a lot of going on in permanent insurance. Today, the biggest takeaway is buy the correct amount, and if the premium is high, the 2 ways to move that, in my opinion, is either reduce the years you want to replace either your expenses or your income, whichever method you chose, or reduce the amount of term that you're choosing. So instead of 20 years, drop it to 10, and then really take a hard look at, the premium on a monthly basis might appear high, but when you back down and look at, how many dollars per day it takes, to cover your family, that's one thing to consider, that it's not, $3 million is going to run through your hands if you're making 100,000 a year for 30 years. And so we like to see that. One last thing I think I'll throw in there is sometimes you have couples that, one spouse works and one spouse doesn't. It's becoming more rare because, of course, inflation and things are more expensive. But in those particular cases, I just want to say that, let's say the spouse is staying home and is a homemaker and raising the children. There's no income there. So it's like, well, I don't need any income, right? Well, no, absolutely. Because if that individual, the homemaker that's staying home, dies, well, there's no income. So there's nothing to insure. Well, no, because now if you're a wage earner and you're earning, are you still going to be able to earn that money if you're having to come home and do the tasks that your home, that your spouse was doing at home? And so we like to always advocate for those families that, have, someone staying home, raising the children, doing what they are, we always, even though they don't have an income, they're still working hard. We advocate for insuring for that, because it's likely that your income while you're alive will take a drop if your spouse isn't there to help in those situations. So I want to throw that in there, but
well, clearly, I was
yeah.
going to say, clearly, this is not like a one size fits all kind of formula. It sounds like people need to go sit down with their financial advisor and discuss what fits them the most appropriately.
Yeah, absolutely. It should be tailor need. And, again, the default is, a needs based, just the rule. And I'll just kind of close with that is, what do you make per year? Multiply that times, the number of years you plan to work, and compare that to what kind of insurance you have now. And is it enough? And if it's not, we would suggest you reach out to us or to, a planner and get that accomplished, because it is, and I can say again firsthand, it's very, very impactful. And so, again, I'll just leave with the phrase, if you're going to go through life with planning for all these goals and dreams, why should your family miss out on those because you're gone? And for a fraction of your earnings per day. So
True. It's true. It's an awkward conversation for a lot of people, but it's a necessary conversation. And for those who are listening who, may find you interesting or compelling, how could they reach out to you to perhaps talk about
yeah.
their needs and what might work for them the best?
Yeah, the best, just we can schedule a brief 15-minute phone call to discuss, the concerns, and then kind of take it from there. There's no cost for that. You can reach us at 559-897-0040.
Yeah.
Or, our website, there's a way to schedule. You can go ahead and schedule a meeting that way as well. We can do a virtual meeting, much like we're doing. Well, if you're listening, you don't see it, but on YouTube. And then, of course, our website has some other additional resources too. You can contact us and we'll be available. So we'll have some resources in the show notes that I think will be helpful for individuals, and they can take either with us or, with their current agent, if that, for that matter, just to make sure. I really want my outcome, or my hope. I just can't talk right now. The hope, maybe I haven't eaten lunch. My hope of today is that people have the right, if after listening to this, they go out and have the appropriate amount of coverage, whether it's with, they do with our firm or not, is the amount of coverage, it worked for my dad. My mom's able to stay where she was, and he didn't buy enough. So, I'll just kind of leave you with that.
Well, that sounds good. No, that sounds good. And thank you for talking about it. And we hope that the folks who are listening think about it and decide they're either good or maybe they need a further conversation with you or their financial advisor. And the other thing we'd ask is those of you who are listening, if you're not a subscriber already, hit the subscribe button and subscribe. That's easy. It's simple. And then you're notified every time Jason turns out a new episode of his podcast, you're notified. The other thing that we would ask, if you like it, rate it, tell people about it, share it, get the word out. Nothing like word of mouth marketing to help spread the news about a podcast. Until next time, I'm Bill Tucker. On behalf of Jason and everybody at Coddington Wealth, I want to thank you for taking the time to listen today. and remind you that you can go out today and make it a great day or not. It is your choice. Thanks so much for listening.